Hi, everyone. Good afternoon, and thank you for joining us for DBA and Edge's market update today. First off, we will hand it to Dr. Maren Bozic to give us a little bit of an update on where we are in the dairy market, and then our CEO, Tim Trotter, and I will talk a little bit about our milk pricing reform priorities. So I will hand it over now to Dr. Bozic to start it off.
Thank you, Michael. We need to enable my sharing the screen. Show my screen. Okay. And since I have 5 screens, it will take another second for me to discover which screen I'm sharing. So bear with me from beginning. Okay. And we want to share a different screen. Okay, I think we're good now. Well, good morning once again, or good afternoon rather. A lot of developments in the spot market. I'm sure that a lot of people on the webinar today have been checking their phone about an hour ago, wondering what in the world is going on with cheese prices. Another day of quite substantial declines in both blocks and barrels. When we tabulate our implied spot later today, we might even find it on the class 3 basis, we are below $18. So lots of questions. Let's see what's happening around the world and that is pertinent to your milk checks. First, let's take a look at the evolution of futures prices. So what we are showing here are the term structure of futures prices as they were a month ago. That's the gray line. A week ago, that's the orange line. And then what's happening today, actually yesterday, end of day, that's the orange line. So you can see that a month ago, when you look at the fourth quarter of the year, we were well over $20 per hundredweight, still not as high as we were maybe 6-7 weeks ago, but still rather high. That has mostly melted. The entire second half of the year, going into first, even second quarter of next year, a lot of that premium has evaporated. Partially because of the fears of recession, partially because of lower grain prices. And our spot as of yesterday was below $18.50. By the time we plug in today's cheese numbers, we could well be under $18 per hundredweight implied spot price for class 3 milk. On the class 4 side, the market hasn't been as dramatic. This is a month ago, again, gray line. A week ago, orange line, and then green line yesterday, end of day prices. The back end of the year, in the first quarter of 2023, we have still seen a drop of over $1 per hundredweight, and going into summer 2023 as well. But the front months have, for the most part, still been holding steady on the class 4 side. A big question is, are we in a recession, right? Why do we care? Well, because if we are in a recession, in previous times when we did have a recession, it correlated with lower demand for dairy or slower growth in demand of dairy than typical, and then milk prices do tend to get down a little bit. Well, the first proxy that folks look at when they are deciding whether we are in a recession or not is what happened to the GDP growth last quarter versus the same quarter last year. In the last 2 quarters, the first and the second quarter of 2022, we have actually been seeing lower GDP than the same period of 2021. So then, a famous spat in the media is that the Biden administration is moving the goalposts because they're saying we're not in a recession, whereas we had 2 quarters of GDP decline, which typically would indicate a recession. So I thought it might be interesting for you guys to just take a second to discuss who defines a recession. Is it Biden's press secretary? Is it the leader of the House, or some other entity? There is actually a small committee of highly esteemed economists listed here on the chart from top universities: Stanford, MIT, Harvard, Princeton. And they are not appointed by the current administration. They're part of National Bureau of Economics Research, It's called Business Cycle Dating Committee. It has nothing to do with arranging couples. They're not that kind of dating. They're assigning dates when recessions start and end. And they do look at what's happening with GDP, but they look at beyond that, what's happening with retail sales, what's happening with employment rate, unemployment rate, labor participation rate, etc. Long story short, they have not declared a recession yet. However, if we do have one more growth of negative GDP, that is most likely going to correlate with other indicators showing that the economy is slowing down. What has perhaps made stock market a little bit more bullish than one would expect just a few weeks ago is the announcements, or comments rather, from Federal Reserve that they see the current interest rate as neutral, and they do not see at present time further needs for tightening the interest rates. In other words, they're saying we've lifted the interest rates enough to not propagate inflation through lax monetary policy. Now we're going to take a step back and look whether we have tightened the leashes too strongly, or we need to move forward and keep on increasing the interest rates. The higher interest rates, of course, the more expensive your operating loans are, the more expensive it is for people to buy houses, and that's the way the higher interest rates curb the economic expansion. Higher interest rates also have another impact. We rely on dairy exports to clear our domestic markets. Our exports are made more difficult when dollar is strong, and they're made more easy when dollar is weak. Well, when our interest rates are higher than the rest of the world, then dollar tends to be stronger or becomes more stronger versus yen or euro. So we have dollar is very strong right now because European Central Bank only increased their interest rates to 0. No, that wasn't a typo, or I did not misspeak. Their interest rates were negative for a long time, and they finally now raised them to 0. Our interest rates are over 2%. So they are much, an independent investor would find it much more lucrative to come to US versus Europe, just looking at the difference in interest rates. So the way you compensate for that is by rising dollar up front. And that's what has been happening in the markets. Looking at the GDT auction, an event that happens every 2 weeks and serves as a bellwether for world benchmark prices in dairy. An event that happened just 2 days ago had the average price across the entire dairy complex down 5% versus the auction that took place 2 weeks prior. When you look at the prices in a dollar per pound basis for butter, $2.36, that's still almost 70 cents cheaper than the spot price for butter in the United States. So our butter is not export competitive right now. Cheddar cheese, $2.18, that is more expensive than the current spot price for cheddar in the United States. So we could see that there will be some upward pressure on cheddar from the export market. However, you typically book export sales 2-3 months out, not on spot purchases. So even if our overseas partners do book more cheese sales, we will not see that immediately in the spot market for cheddar. And then skim milk butter, we are pretty close with the rest of the world. See, what the difference is that on butter, we tend to be net importer. On cheese, we export a tiny bit, 5-6% of cheese we make. But on the skim milk powder, or we call it non-fat dry milk powder, very similar product, we export over 50% of everything we make in the country. So we have to stay close to the world prices. It's not even easy for someone overseas to bring butter to the United States and push that butter through CME to lower the prices here, because the butter specifications are different in the United States versus the rest of the world. Let's talk a little bit about geopolitical risks. I will admit I was following Nancy Pelosi's plane as it was making its way north to Taiwan from Indonesia the other day, wondering what will happen, whether that's the eve of World War III. My favorite tweet that I've read this day is that it must be the case that Nancy Pelosi bought all the puts if she's going to Taiwan. A little joke on allegations that her family is doing insider trading. I will not comment on whether they're true or not. But we do live in volatile times. You're well aware of all the skirmishes and wars that are happening in the Eastern Europe. That doesn't seem to be ending yet, though the Russian advances have been quite arrested over the last month, ever since the high mobility rocket systems have been delivered to Ukraine that have a longer range. So Ukrainian fighters now have artillery that can parry with Russian. The improvement out of Ukraine is the deal to allow Ukraine to export more grains through the port of Odessa. That will have stabilizing effect on grain prices around the world and dampening. So far, it seems to be doing okay. We have not seen, despite Russian attack a day after the deal was signed on the port of Odessa, the deal hasn't been declared dead. So there's hope that will actually go through, that the grain will flow again from Ukraine. In the meantime, on the other side of the world, China has forever considered Taiwan to be part of China. And even the United States has a one country, two systems policy, meaning that we are trying to not to anger China while at the same time have diplomatic relationships with Taiwan. Eventually, as China gets strong enough militarily, I think that there's going to be some military action there. If you recall what U.S. was doing in late 1800s, or as we were expanding, we captured Hawaii and Philippines, like all kinds of new islands at that time, and even before that, westward expansion of initial U.S. It just happens. Like they are now rising in military power, and they will eventually seriously consider doing what we were doing 200 years ago. So whether that happens this week, I don't think so. But down the road, that is a threat that cannot be dismissed. Talking a little bit more about China, I heard on a dairy podcast recently, I think it was a Jacoby Dairy podcast, that there are no, or was it maybe a written commentary from them, that there are no obvious bubbles that need to pop. Reference was that in the late 2000s, we had to deal with the overheated housing sector. There was a housing bubble that needed to pop going into 2009. Well, now if you look at prices in US or markets in US, where is that bubble? Well, I think that the bubble actually may this time come from outside US. China real estate has been problematic for a long while, and recently I've even seen news of bank runs there. People literally showing up in front of the bank and protesting, wanting their money back. That's not a good sign for the Chinese leadership. Take a look at the Chinese consumer confidence. This was back in June with the COVID lockdowns, how steeply and suddenly it declined. The most recent data would probably show some recovery of that. But I think that whenever you have the legitimacy of the political administration be based on strong growth, that is bound to induce poor investments to fuel that growth, and eventually enough bad loans need to backfire. So they do have a lot of great things going on for Chinese economy. In terms of their people are much more educated than they were 20 years ago. A lot more infrastructure is in place, etc. But their foundations are still rotten. And I don't mean that as a judgment on their political values, but just in terms of economy, the way you get loans there is not based on solid cash flow projections, but there are a lot of political interventions there. That cannot do well in the long term. I do anticipate that there'll be some headwinds from Chinese economy. That may start this year and going into 2023. In the United States, in the meantime, one of the reasons we've seen strong dairy prices is because we were exporting well. Whenever the share of milk solids exported is rising, then all milk prices are rising or stable. Whenever the share of US milk solids exported is stable, U.S. all milk price tends to drop. Why? Because our cows are getting better at a faster pace than our domestic demand is growing. That has been the case since World War II. That's not a new phenomenon. However, the way we dealt with that discrepancy in trends for 4 decades is through reduction in number of cows, consolidation. Then sometimes about 15, 17 years ago, we no longer needed to reduce the number of milk cows from about 9.3, 9.5 million because we added a new demand channel that were the exports. So exports not only need to be strong, they have to be growing as a percent of US milk production to keep the US all milk price from falling and inducing the reduction in dairy herds. This is that relationship that I just described. So what you see here on horizontal axis is the all milk price, and on the vertical axis is the strength of exports versus their linear trend, versus because they're growing. When exports tend to grow faster than normal, then our all milk price is stronger. When our exports tend to grow below trend, then our all milk prices tend to weaken. So we'll see what happens with the exports if we indeed do have a worldwide recession. I'm going to skip some of this in the interest of time. We only have 5 minutes left. If I had to only answer the question, are you bullish or bearish based on what's happening with milk production around the world? Here's what my answer would be: absolutely bullish. New Zealand discovered they're an island some time ago. Yes, they may grow this year a little bit. They will never again grow the way they had grown, that fast growth that we experienced through 2015. So they're not a factor that's going to sink the world markets anytime soon for for years and years to come. Europe was growing very strongly from 2015 through 2020 or so. That has also fizzled out. They are now much more concerned about climate goals than about ag exports. Add to that higher cost of production, higher livestock feed, higher energy costs because of the wars with Russia, and the dairy farmers in EU are not in a position to grow. So we are seeing declines in milk production there as well. And then, of course, until very recently, even United States wasn't growing again. So across the board, milk supplies are not going to overwhelm the market. That's not why prices are going to go down. If they do go down, that's going to be on the winds of poor demand. And with recession on everybody's mind, that's where the fear is coming from. This is the U.S. all milk, U.S. milk production year-over-year changes. You can see that we had 6 or 7 months of year-over-year declines, and the final numbers for June are indicating that we have grown year-over-year. I'm going to skip a lot of slides in the interest of time, and I want to just show you my team's forecast. This is versus yesterday's futures prices. So you can see that heading into 2023, we think that the current class 3 and 4 futures, again, yesterday end of day settle, are probably too optimistic. And we wouldn't be surprised if for the first half of 2023 we see prices that are between $0.75 and $1 lower versus futures as we have seen them yesterday. Similar patterns in class 4. This is again mostly our concern about demand, not the concern with overly strong growth of supplies. The question always then becomes, what can you do about this? Everybody should sign up for DMC. You almost don't, well, you don't need to do any analysis, really. Like with that program, it's once and it's sign and done and move on. So for 2023, the sign up will be open in about a month or two, and everybody should do the first 5 million pounds at 950. There might be some payouts in 2023 for DMC. Beyond that, we now, for all the quarters for which the sales are closed already in the last 2 years or so, we are consistently seeing that DRP is covering about 1/3 of the milk in the country. A good way to think about DRP is a tool that allows you to layer in coverage far out when you don't yet know when prices are going to go up or down. So some of folks on this call and maybe others who will be listening to a recording will say, well, we missed the opportunity. Prices were high 6-7 weeks ago. We didn't pull the trigger at that time. We missed the opportunity. Here's my take on things. When you really like the markets and you want to book everything, don't book everything. Book some portion of your milk. Keep some powder dry, pun intended. And when you really don't like the markets, where you believe that you missed the opportunity, rather than doing nothing, do a little bit. And always start layering 4 or 5 quarters out and then gradually build that up over time. If you do it that way, you will most likely going to minimize your regret of either missed opportunities to lock prices while they were high, or of missed rallies that would have allowed you to book coverage at higher levels still. So layering in, rather than having 1 or 2 endorsements per quarter, having 8 or 10 endorsements per quarter is going to make any one individual decision, and you will not feel that you have either committed yourself to some bad outcome or that you're too late to the game. It's 20 past noon, so I think that this is all the time I have. Maybe there'll be a Q&A in the end, but now back to you, Michael. Or Tim.
Thank you, Dr. Bozek. I appreciate your comments, and obviously it's always a robust conversation when we're talking about dairy pricing and we're looking into the future. I would like to take a few minutes to talk about something else that really goes hand in glove with markets, and it's talking about federal milk marketing order priorities that EDGE has recently announced. We've taken over 2 years to work with other states, to work with our members, other stakeholders, really discovering what are the opportunities for the future for the federal orders, and how do we need to look at them in the future to make sure they're relevant for our members. And realizing that, there's 2 core things that we really believe is really important, that is flexibility and fairness. I think all farmers kind of gravitate to those 2 words, but they mean a lot more than that. And I think when we look at our milk sheds, when we look at our priorities, one thing farmers have told us time and time again, they want stronger relationships with their dairy processors. So we really believe that when we look at reforms, we want to make sure that we have increased transparency, fairness, and competition, and also give farmers some type of price certainty. How can they mitigate risk? How can they operate their farms? How can they grow for the future within the current system? And we also realize that farmers, in the past, we sometimes look at our transactions with the processors as more of a transactional relationship. What we really believe for the future, it needs to be more strategic. Farmers need to understand where their products are going, what markets they're serving, what's going to make them competitive in the world marketplace, as Maren was talking about, the role of the competitive markets worldwide, and just understanding that at the farm to the processor that we're aligned well, and we understand what the goals that we have as a market milk shed. We want to make sure that at the end of the day, we all succeed, because we need a strong farmer base. We need farmers that can, really, not be as vulnerable in the marketplace, but also align with, processors and markets that make sense to them. So what I'd like to do is take a few minutes. We're going to have Mikkel kind of review those priorities. And again, this is kind of the first stab at it. I mean, we realize that there's going to need to be a lot of collaboration, a lot of communication with others. But again, I want to thank all of you as members who have participated and given us guidance in this. So without any further ado, we'll turn it over to Mikkel. Mikkel?
Thanks, Tim. So a little bit more on our thinking before I get into the priorities. There are huge differences in product mixes in different regions throughout the country. So we believe that more flexibility within those orders will be beneficial. And fair and equitable dealings between processors and producers is also necessary. And so a set of standard contracting principles would strengthen those relationships and increase the trust between them. With that, we know that not everyone participates in the federal milk marketing order system. And we think these changes are going to be good for both processors and producers, whether the orders are in place in the future or not. And so transparency, trust, and collaboration and a more attractive marketplace is really the goal for our priorities. So the first priority is flexibility. There are 11 different orders within the milk marketing order system, and they all have different product mixes, geographic considerations, and farmer bases. And we want them all to be able to operate in a way that makes sense for them. There is currently some flexibility allowed, but we would like to see a change in federal regulation to allow us to do even more. There are currently some unintended consequences with the uniform price rules, such as frequent depooling and negative PPDs. So something that could help avoid that in the future is moving to a uniform benefits approach as opposed to a uniform price approach. In order for us to make that change, we would have to make that federal regulation legislative change that I was just talking about, which would then allow us to be followed by a collaborative USDA federal order hearing process in which individual orders where folks can work together to come up with the best way to implement a uniform benefits approach for them. And then the second principle that we have been working on, or excuse me, priority that we have been working on is fairness. EDGE feels that there should be a standard set of contracting principles that would make the pricing system more fair. We are recommending 10 principles for contracts that would increase transparency and trust between the two parties. They'd help processors compete and innovate at the same time as well. So there's kind of 3 buckets within those contracting principles. So the first bucket is basic contractual expectations. Some of today's business transactions between farmers and processors are somewhat loosely arranged, and so we are proposing some basic contractual expectations that would create some structure and certainty. So the first within this bucket is written contract. All milk supply arrangements should be in writing. The second is timely payments. Farmers should be paid in a timely manner every 2 weeks, and makes sense, and with no more than 3 weeks lag. Advance checks should be paid in accordance with what's known about the current market conditions. The third is verification of weight tests and standards. So unless the farmer opts out, there should be a third party certifying those services, and those verification organizations should be able to also perform other services for farmers. And the last one in that bucket would be contract termination notice. Other than in extraordinary circumstances, we believe that processors should give a reasonable amount of notice before a contract is terminated. The next bucket of contracting principles would be competition. A competitive dairy market is healthy for both farmers and processors, and we think that the following contracting terms would lead to a more financially sustainable farms and drive a competitive marketplace for processors. The first would be transparent pricing formulas. So for farmers to be able to manage risk and understand the financial implications of improving certain quality standards and improving certain practices and quality incentive programs, it must be clearly spelled out in those milk supply agreements. And there should be sufficient notice given before the incentives change. And at the same time, processors should be able to set their own pricing formulas as needed in order to compete in domestic and international markets. The second within the competition bucket would be competitive risk management. Farmers should be able to effectively manage price risk using a combination of processor-specific basis contracts and government or private risk management tools. And the third would be exclusivity and volume limits. Processors should not impose exclusivity if also imposing volume limits and 2-tier pricing. And the final bucket within our contracting principles is equity. So equity is fundamental to these priorities. Under our contracting principles, farmers would have equal opportunities and processors should be treated equally, and both would be assured that they're operating in good faith. So the first is good faith principle. Both farmers and processors should act in good faith, and disputes should be addressed through an arbitration process with meaningful penalties to address unfair behavior. There should also be equal opportunity for all farmers. No special deals should be allowed. Any incentive payment offered to one patron should also be offered to all other current patrons, as long as they meet the same criteria, such as farm location, size, and milk quality. And then the last milk pricing, contracting priority would be equal treatment of processors. These contracting principles should apply to all milk buyers in the country, regardless of their ownership structure or participation in the milk marketing orders. So that's a quick overview of our two priorities, the flexibility, the regional flexibility, and the basic contractual principles. And so I'll hand it over to Tim to talk a little bit about our engagement and our plan moving forward.
Thank you, Mikkel, for that overview. We have been very active talking with other national dairy groups, regional dairy groups, talking about our thoughts on this. You know, when you look it over, there's some ambiguous areas where we haven't totally baked everything in the oven yet, and that's by design. We want to be able to have meaningful conversations to make our list better, and maybe there's areas that we've missed. So we're going to spend weeks and weeks of talking with others, listening, having these, and I think we have 2 or 3 meetings this week alone to talk with other dairy groups. So again, it's inspiring because I think a lot of our young farms, and you know, we've had a lot of our farmer-to-farmer meetings over the last few months. You know, a lot of them are asking for, you know, what's the future for dairy? You know, all those uncertainties. So we want to make sure that we have a system that's really going to give them that certainty that it's worth the risk to go on to the next generation. But again, we want to also talk with our farms. I mean, again, there will be a lot of things kind of moving targets here. We want to make sure the communication lines are open, not only with our board of directors and our members, but also with the processors, because again, it's got to be a win-win to really advance our industry for the future. I think now what I'd like to do maybe is open it up. Maren, you want to join us as well, and we'll take some questions. And I'm not sure how we're going to take the questions, Mikkel. I guess I'll throw that back to you.
Yeah, of course. Please just put your questions in the question box or even the chat box. We'll be able to find it somewhere. So just type those in, and we can answer them, either Maren or Tim and I. So I guess I can start with a question that we hear quite a bit from our members when we talk about our milk pricing priorities. The second priority is setting up these contracting principles, and they are supposed to be for whether a federal milk marketing order exists or not. So is the plan here to, do we see the federal orders going away, I guess, is a question that we get often. And so, Tim, do you want to take that?
I'll take a shot at it and then turn it over to Maren. I think what we have to realize is there's a large percentage of the milk that is unpooled, depooled. And we want to make sure that our farmers have guardrails of how this is going to work outside of the federal order. I think if we look in your crystal ball, everybody would have a different answer where they feel milk marketing orders are going. Our priority is to make them relevant, as best we can. But there will be times, and we know in history has shown us, where they don't fit all processors and all farms and all regions. So I think we just need to make it better, but also understand that we need assurances if we're outside of the milk marketing order. Maren, do you have any other things you'd like to add?
If you ask a question, what's a fair milk price? If you have 5 people, you'll get 7 opinions, right? So we used to rely on uniform price at your component tests to be that arbiter, if you will, between processor's opinion on what a fair price is and what a producer opinion may be on a fair price is. Because a uniform price at test, when orders are functioning properly, should be enough for a processor to cover their costs and then capture any upside from value-added activities. And also, over a long run, should be enough for dairy producer. If it wasn't enough for many dairy producers, then milk supply would contract, and which would push the milk prices higher. When we have massive depooling, when we have frequent depooling, when we have the even processors who would be able to pay producers more if they pool right now, deciding they're not going to pool, something is wrong. You know, that idea that we can rely on uniform price as a metric of what a fair price is no longer there. And EDGE's proposal will hopefully reinstitute that. You know, that your milk check would be more predictable, easier to understand. We would do away with PPDs that can hit you once in a while, you know, with a club on the head with $3 negative. You know, and then you're like thinking, what's going on? I have to fund my hedge accounts because futures prices is going up, and now I'm getting docked on my milk check, and it's a double whammy. That would all go away. You know, and if we reform it in this way, not only will federal orders survive, but they will also perhaps again thrive in the upper Midwest, and we could rely on them to provide us a sense for what a fair price is, or at least the fair minimum price over which processors can pay premiums for, depending on the market milk availability.
Thanks, Martin. And I still don't see any other questions, so I will ask another that I hear often, which is, what do the processors think about this proposal? And also not only processors, but other groups in different geographies.
Tim, you want to take that one?
I'll start. We have obviously through the whole process with the task force and over the last 2 years, we've had ongoing conversations with a lot of our processors. I think much of what we have in there is really standard business for some of them. When you talk about written contracts, you know, many of them do use written contracts. You know, again, I think they all have a different twist and what they would consider as something that they would get on board with. But I don't see them pushing away too much. I think it's an interesting concept. I think they understand the dynamics of the industry now, but it's going to come back to the details. I mean, that's where we automatically go, what does this mean? How will this work? And I know that's why Dr. Bozek is working with us to come up with some white papers to help, you know, kind of visualize how this could work. So I'm encouraged by the responsiveness so far from our dairy processors and dairy farmers both.
Great. I am not seeing any other questions right now. Got a quiet group today.
I have a question for you, Mikkel. You know, when we talk about enabling legislation, what would the timetable be on this? Do we have a crystal ball on that?
No one quite has a crystal ball, but so the thought on this would be, as you mentioned, these have to be legislative changes. So both of these priorities would have to go through Congress, and the most logical vehicle for these to go through Congress would be on the Farm Bill. And so that's kind of what we're looking at right now. It is not set in stone, and it is not the only, you know, avenue, but it does make the most sense as, you know, the biggest ag bill that goes through every 5 years that must go through. So we have not made any asks yet on the Hill because, as you mentioned, we are currently going through the process of a collaboration with other groups, trying to decide what a final ask would look like. But we have made the main folks on the Hill in the ag sector aware of what, you know, we're looking at here, and we hope to have something final to go with them, or to go ask for their support in early next year.
You know, I did have a question from a farmer yesterday that I think is relevant. You know, early on during PPDs, we came out with our Class 3+, and farmers are wondering, so is EDGE not still in favor of that, and how do we plan on handling that? So I would just like to clear up that that's still in play. I mean, there's a lot of tactical tweaks being just considered with the federal milk marketing orders that are more, I call them tweaks. It could be make allowances, could be other items that you hear a lot about in the press. EDGE is still considering and still relevant in all those conversations. But again, we're deciding to go big picture because we really believe now is the time to take a greater look at the whole overall reforms to make it more relevant. But that's not to say that we're not going to be heavily involved in some of these important issues regarding change.
Yep. And we have a question from the audience. Maren, if we fall into a recession, how long may that drive milk prices lower?
9 months. We don't like to stay in a recession for a very long time. So if we really do fall back into recession, probably federal government will find another way to intervene to kick us out fairly quickly. The only caveat would be that if that recession is caused by increasing military conflict overseas, and if that conflict grows from being local into global, I'm not seeing that as a likely scenario at this point, but just doing a thought experiment, then it could be much longer. In previous times, world wars would last 3-4 years. So again, I'm not saying, I don't want any headlines. Bozic says there's going to be a third world war on his webinar with EDGE. That's not a likely scenario at this point, but in terms of can you really plan for all of that? No, probably not. For the tools that we have available today are good for short recessions. DRP doesn't allow anybody to book their prices for 2024 at this point. So anything that's super long, that's caused by some massive events, we would need to complement market-based tools with some other interventions from the government.
All right. Thank you for that. We do not have any other questions at this time. So is there anything that you, Maren, or Dr. Bozic or Tim would like to add before we end a little bit early today?
Maren, go ahead.
I would just like to invite everyone again and again to stay engaged, stay involved. Everybody on this call here is here to serve you. And we can best serve our members if members come forward and ask questions, express concerns, anything that you see that need changes, in a sector, within your relationship with your milk buyer, etc. Bring it forward. We'll keep confidential what needs to stay confidential, and we'll try to derive from that conclusions that can be applied to the whole system. And all the good ideas come from our interactions with dairy producers. None of that is hatched in a lab, if you will.
All right.
I would just echo what Dr. Bozic said. In being engaged politically, we have a very important term coming up here with elections. Please vote. Keep in contact with EDGE and DBA when we get into the general elections. I mean, farmers need to lean in to the elections. However you may feel, please lean in. With that, I'll turn it back to you, Mikhail. Thank you.
All right. Well, I think we are finished for the day without any other questions. So thank you everyone for joining us, and have a great afternoon.